Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site is Cabasso and Maddie Radner on the Nasdaq Market Intelligence Desk, as well as Jeff Bernstein, Senior Managing Director in Equity Capital Markets at Riveron. And we are here to discuss how the market environment is impacting the IPO landscape and what leaders should consider when deciding to go public. It is great to have all of you with us. Jeff, I'm going to kick it off with you. Starting to get more pitches around the IPO environment, which leads me to believe that there's a lot of thoughts around what's happening in the current market environment, or things are starting to heat up in the pipeline.
They definitely are. I mean, in the third quarter of last year, things really started to change where companies were really pens down through most of 23 and the first half of 24, and valuations were obviously doing well. So a lot of companies started a readiness process. Now, that obviously over the last month or so, it hasn't changed trajectories, but I think there's been some choppiness. We are going to test the markets a bit in the next few weeks for some IPOs, but I do expect the tariff talk means the market's been up and down a lot on news on tariffs specifically. April 2nd is going to go. I imagine that the tariff talk is kind of going to become more surgical than not, and we're going to move on to first quarter earnings. So we're going to test the markets with some great IPOs, hopefully, and then get into Q1 earnings, which might be a little jumpy.
Well, Max, it's interesting. There was so much exuberance coming into or following the election through the inauguration in the middle of February. So to see a little bit of a reset is not surprising. What I do think companies need to keep in mind, though, perhaps when April 2nd comes and goes, tariff talks might be something continuous in this administration. So adapting to a new or a different operating environment is not far off.
Yeah, I think, like you said, we had, I don't want to say irrational exuberance after the election, but the stocks ripped. We ended it at the highs. So coming in, I mean, look, we're in correction, it's 10% at all-time highs. It happens. Stocks don't just go up constantly. I think the tariff talk is just that uncertainty, which we haven't really had a lot of outside of the Federal Reserve. That had kind of been the driving narrative behind everything, is what is the Fed going to do, and then the AI trade. Now it's just uncertainty. Like you said, April 2nd will come, maybe get a bit more surgical, see what kind of deals get made. There's been a lot of talk of American exceptionalism. Is that fading? I don't think U.S. tech is really going anywhere. I think, like we've talked about, companies are going to manage through it, learn to think about a few weeks ago when the first tariff headlines really came out. It was sharp drawdowns, sharp retractions. It was very quick. Volatility started to spike. We've seen volatility really start to come in with prices not really moving. So that vol is just starting to decay. I think each headline, you're getting less and less and less of an effect on the market. People understanding, okay, this is negotiations. Let's see what happens on April 2nd and prolonged. Okay, is this a short-term thing? Deals are going to be made. I think companies are going to manage through it. And like you said, I don't think tech is
Maddie, we had this conversation with the guest a couple weeks ago, and he brought up a really good point where rip the Band-Aid off, get it done with the tariff talk versus, last time 1.0, we were waiting to almost 2 years into the administration and having to guess what that might look like. So, rip the Band-Aid off. It was almost like, the European trade at the beginning of the year, the risk was to the upside.
Yeah, I think if companies are ready to IPO, they should move forward with their plans. I know Jeff's been working with a lot of private companies who are readying for the public markets. Over the past couple of years, there has been a backlog of VC and PE-backed companies who've stayed private for longer. They've had a robust access to capital being in the private market, and these companies have successfully gathered billions through secondary share offerings. But at some point, these companies will require more formal exits so shareholders and investors can get access to this liquidity. And we're seeing companies start to test the waters. We're seeing CoreWeave, Klarna, a lot of companies on file looking to tap in.
Yeah, and I would just say as well that, look, what's happening right now, if you think of perhaps the rhetoric maybe dying down a bit, we get into Q1 earnings. Earnings may not be great. Companies aren't going to earn a lot by saying business is great. It's good for them to pull back a little. That coupled with probably a slightly softer consumer, slightly higher employment, incentivizing the Fed to act. The administration wants to pass some fiscal stimulus over the summer. So you've got Fed, fiscal stimulus, kind of softish activity. That could set up really nicely for the second half for the IPO market. So we're going to test it here, but I imagine the real activity, if things go as planned, we're going to set up for a really important back half of the year into 26.
Yeah, and you make an interesting point in your notes here as well. When we were coming out of the last IPO slump, it was more about the public markets. We're hearing much more about PE and VC. So it sounds different this time around.
It's different this time.
Cliche, but hearing a lot more about the private side of things.
Look, we all know, we've gone through 3.5 solid years of stay private longer. I think VCs are under pressure to get return money to LPs. I think private equity also needs to show that they can get, some of those companies are too big to trade again into private equity, so we've got to get those out into the public markets. Public investors want new companies. I mean, the last time we had a lot of new companies was 2021, and a lot of those, there have been few winners and lots of losers, so we need new companies coming into the public markets. It's in the best interest of the companies to go public, earn their stripes over the longer term, for sure. And that's in the old days, that's when you earned valuation. It wasn't like the 2021, let's price at the top. So I think getting into that cadence is good. Public investors want it. Private equity may pull back a little given because of, they've got high levered companies, whatever it is. But I think the 26, 27 year, because 28's an election year, like we've got to have this happen in the next 2 years, because 28, I think, is going to be a tumultuous year.
And I also think the 2021-22 reset needed to happen.
Oh, God.
Right?
Sure.
Growth at all costs. There was no profitability, no earnings to be heard of. Retail investors, by the time of IPOs, they're the ones stuck holding the bag. If you want to keep confidence in the U.S. public markets and maintain that leadership, you need the public investor to have confidence in what's coming to market.
Absolutely. I mean, and having good public companies is it's great for employees. They have a plan to gain liquidity. All these secondary sales, which are good by venture and early stakeholders and companies, that's okay, but you need to strengthen the employee base, and they know that they own something, that they can go home every day and say, look, over time I'm going to earn a lot of money, et cetera, et cetera. So it's good for employees, it's good for corporations, and obviously it's good for the United States. And that's something that I think we need to keep well intact, because we are still the best market in the world, but we need to keep filling the public markets with great companies where retail investors and others can access.
Yeah, with the retail and greater visibility, it's easy to stay private when there's capital there, but paper profits are just that, they're paper. You still need to monetize at some point. You can have private valuations as high as you want and not have to move the marks on a daily basis like the public market, but somebody needs to get liquidity, they need to sell, there needs to be buyers there. It's a lot tougher on the private market. Again, I've seen it in a fund I was at a few years ago. We had private marks that were great, and then it's, okay, we need to start returning some capital, people near the money, and it's, okay, now we need to find a buyer for this. And it's a lot more difficult in the private market than the public market. And again, just going back to companies being interested in IPOs in the coming days or coming months into the next year. I spoke with somebody on the digital asset side yesterday, and one of the large providers in this space that are interested, they're kind of getting their ducks in a row. They want to be ready. They're not going to go in the next month or two, maybe the back half of the year, early next year, but they want to be ready when everything lines up like they're expecting, kind of get the headlines and the headwinds out of the way. When it's time to go, they want to be ready and put the iron in the fire and get going. They don't want to just sit and miss it again like they did 2 years ago. We saw these valuations and they missed it. They want to be ready to go.
I think a great sign, what we're seeing now, is a little bit of a pickup in M&A activity.
Yeah.
There was kind of a lot of excitement heading into the year that, M&A is going to be back. It's not as strong as we all expected, but it is starting to pick up, especially in the private market space. There's been 11 acquisitions across VC-backed deals with valuations of $1 billion or more. This time last year, we only saw 2 deals with a value of 3.2 in total. So that is slowly picking back up, and I think that could provide a good runway for IPO activity.
Yeah, especially if the larger IPOs that are coming to market in the next couple of weeks, if they perform well, that's going to be a benchmark. A lot of other companies that are thinking of going public, that's going to be their baseline.
Yeah, I tend to not pay as much attention to aftermarket trading activity. I mean, if you look at the crop of companies that came public so far in the first quarter, you've had some few clunkers for sure. And you look at last year's crop, again, few winners, maybe a few more losers, but I wouldn't take that as a barometer of what's to come. I think, look, you've got some really good companies, CoreWeave, Klarna, and then you're going to have Hinge Health and eToro and StubHub. You know, these certainly, and CoreWeave might be a little bit of an exception, but these are more companies that I expect to be decent barometers here because they are not, when I say true, CoreWeave is just the right company at the right time. It's like Astera and some others, the AI, et cetera, et cetera. These other companies are a little more mainstream. They have public competitors that they can be valued off of. It'll be interesting to see the follow through. I would like to see, however, that the pricing of these IPOs stays cognizant of the current economic situation, geopolitical situation. Investors need to build positions over time. Right. And I think what we learned in 2021, top ticking pricing is not a good thing. Take a little dilution perhaps, but earn your valuation over time. That's what I'd like to see.
And you brought up a great point too. Going public is not a one-stop destination. I mean, the super hard work is, now you're managing a company and you're responsible for, you know, quarterly reports and shareholders and all the other stuff that comes along with being a public company. It's that journey. That's a lot of hard work.
Take the journey. You know, one of the things that we do at Riveron in preparing companies to go public, whether it's accounting, reporting, business processes, technology enablement, my capital markets and investor relations work, that should not be work that is done for only the IPO. This is getting muscle, building muscle for a company to build value over a long period of time and getting them off the runway where they're really prepared to be a public company. And if you look at the great companies that came public, you know, even after the .com crash in that kind of early 2003 period, a lot of them came public during very tumultuous times or, you know, not great valuations and went on to become 10 of, you know, if you look at the top 10, a lot of them came public during that period. So use it to build that muscle, use the time to build muscle, and then make sure that you are reasonably conservative with investors. And some of the great companies just have a program of conservative thinking around what are we going to guide Wall Street? What are we going to tell our investors? How do we build trust over a long period of time? And those are the companies that get premier valuation.
Yeah, we've spoken about this a number of times, Max, you know, especially when you're giving guidance in the first quarter. You're trying to, you know, forecast a whole year. It's a little bit different than when you're in the fourth quarter and you have, you know, you're closer to the finish line. I think what's interesting is, and I want to go back to, the real work begins once you become public. And anecdotally, we see this after these big celebrations and the opening trade, and you guys are opening the stock. You could almost see it in the CEO's face where, like a shell shock moment. Okay, now
the work starts.
Now we have to start. It is so discernible. I just got the chills talking about it. It is so discernible and exciting at the same time. But you can. It is like a shadow that crosses.
It's a sense of relief on one
then,
sense.
like, oh my God.
Then it's the celebration. All right, we're officially open. It's a celebration. It's now the journey begins. We always talk about with our companies. This is not just a one-day thing. Yeah. This is a long-term thing where you're partners in this to help you in your journey as a public company, because there's a lot that comes with it. There's a lot more. There's work that goes along with it, but again, there's the benefits that go along with it. But it is a long-term journey. We also tell that to the employees that are here for the company's first trade. It's great to see the stock, the pop on the first day, but try not to look at it every single day. Think of it. This is great. 6 months, a year, 5 years, 10 years. It's a long-term game then versus a short-term, 1, 3, 6 month thing. This is a long journey. There's a lot of work to be done. But again, you get new employees then that help you with that process, and you learn along the way.
Well, to Jeff's point earlier, the top 10 in the Nasdaq 100 that came after the .com boom, Meta, Tesla,
Google.
Right, and Microsoft, Apple, they've been there for quite some time, but like.
But even in healthcare, like some of the big, massive healthcare, United Healthcare, like that is built. Like if you bought all of these stocks at the top tick every year, your returns would still be huge. Yeah. And so you build durability, you innovate and you use capital wisely, you become a good steward of your own capital and spend wisely and build that value over time, the public markets will reward you. Quarterly, can you miss a quarter here and there? Sure, but if investors trust management to execute over a long period of time and see the moats that you're creating, it's going to serve you well. And that's why staying private for a really long period of time and coming out near the top, I think it can sometimes be a little
detrimental,
short-sighted.
Yeah, well, I mean, the whole thing is too, all these booms that we go through, it's like every 10, what's a Godfather, every 10, 15 years you have to go through these things, right?
Yeah.
That's where innovation is born, right?
Yeah.
When we learn from, okay, this is where there was a lot of exuberance, this is what works, what doesn't work. I mean, even the cycle that we're in right now when it comes to AI and everyone's trying to think about what that return on investment from an enterprise level, what does that look like? Is it gonna look like SaaS? Is it gonna be more hardware focused? Is it gonna be more of a hybrid model? We're all learning this. So
Capital
the companies
intensive.
in 10, 15 years from now,
Few winners,
Right.
lots of losers.
yeah. But I mean, we always see those shakeouts.
Yeah, I mean, and we've been in such an extended period of large cap leadership
Right.
where the mid cap space is looking a little bit more attractive to certain investors, especially as manufacturing is being reshored into the US. They're benefiting from easier financial conditions, the cost of capital lower, and then mid cap earnings growth is supposed to catch up to large cap earnings growth soon. So the mid cap space might not be so bad to start off in.
Well, and just one thing, people think valuations are so concentrated in the top. In a period of high interest rates, the equal weighted S&P 500 ETF is up 31% in a year and 4 months. So not too shabby in a period of high interest rates. So when people say it's all concentrated in 7 companies, it's actually not true.
Yeah,
It's a
I mean,
little-
fund managers are paid to deploy capital.
Can own
not-
6 stocks.
Well,
Now, the Russell 2000, which looked like it was really going to break out late last year.
every time, Maddie.
Huh?
Time.
She's
Right?
our small cap specialist, so
Oh.
every time.
And that's really what, again, bankers like the Russell to do well because they're generally bringing public companies with $10 billion market cap or less, or so on, or even 20 or less. Small cap stock, my little concern here is that the consumer, we've got to watch the consumer. We also now have to watch corporate spend because we can have a little consumer softness, but if corporations now start to signal that a lot of the talk around tariffs or whatever is starting to have them reassess budgeting, that could get hard for smaller companies that are not maybe truly global. So I think we have to watch that.
We certainly do. So we're just going to snap our fingers, wait to get to July, and hope for an up year. All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.